CIBC and National Bank getting a downgrade at Jefferies. Our guest is looking at the potential threat of tariffs to our economy, and that's part of his thesis. We're joined now by John Aiken, Director of Research at Jefferies. John, always great talking to you. Thanks very much indeed.
My pleasure. Thanks for having me.
In the past, you reckon Canadian financials, especially banks, they've shown some resilience when times get harder. I mean, people need to go on banking. But you think Canada is vulnerable here. We have a highly open economy and tariffs are a real threat.
Yes, no, absolutely. And what we're seeing right now is a lot of uncertainty in the marketplace. But from our standpoint, realistically, the damage is already done to the Canadian economy. Anecdotally, we all have examples of people pulling back on consumption. But realistically, even if there's some sort of global resolutions within the latest 90-day time period, we do think that we're going to see weaker economic growth in Canada, higher levels of unemployment, and of course that spills over, particularly in the banking sector, into higher credit losses. And we really do not believe that the street's numbers have actually come down to adequately reflect this dynamic over the next 2, 3, 4 quarters. And that's where we have seen the share prices come down. That's the market reflecting this this fact. But realistically, the street is a little bit behind the curve because even 3 months ago, we actually had a very positive outlook for 2025. And that just shows how dramatically things can change with the imposition of these tariffs.
You've turned cool, in particular on CIBC and National Bank, because they've got a relatively high domestic exposure. It's interesting, actually. I was just looking at a 5-year chart comparing them with the banking index, and they've done pretty well over 5 years. But talk to us, though, about why, relatively speaking. So it's just they have less U.S. exposure, for example.
Yes, that's exactly the case. If we take a look at our earnings expectations being negatively impacted by higher credit provisioning over the next couple quarters, then basically as we ripple through the portfolio in terms of our forecast, National and CIBC being weighted more towards Canada and less in other geographic regions, we really did think that their earnings were going to be hit a little bit more disproportionately. As well, to your point, very strong track record over the last 5 years in terms of their share price performance for different reasons between the two of them. But as well, we do think that there's going to be some moderation in terms of enthusiasm the market's willing to pay up for those earnings.
You are keen on Royal Bank and interestingly on TD as well. They're among your favorite ideas.
Yes. So, in the report, we talked about sticking to quality. And in our mind, that means basically the largest operators having to be able to have the biggest platform to defray incremental costs or the or greater earnings weakness through their platform. But realistically, it's also the fact that they're both exposed to the U.S., which is also going to be negatively impacted by the tariffs, but probably not to the same degree, particularly relative to Canada. And basically, we think that Royal's very diversified product offerings are going to leave it in very good stead on a relative basis. But for TD, it's more of the market still getting comfortable with the fact that the remediation that it's undergoing in the U.S., well, it's going to increase costs, really does not actually have any impact on their day-to-day business that they do with their customers. And we think that even in this context of the tariffs, TD has the best chance to have relative multiple expansion out of the group, even if we are in an environment where there's pressure ongoing for the group.
And you think multiple expansion as the concerns over money laundering ease?
Well, just yes, because they're highly unlikely to be any incremental charges or instances of money laundering at TD. And as the market gets comfortable with that, then they'll be willing to get TD back to where it was trading on a relative basis against the group, because right now it's still at a discount against the peer group average.
And you do like the look of Manulife and Sun Life as well.
Yes, again, when we look at the life cos, they have by far the most exposure outside of Canada, as well as the fact that the life cos have really been focusing on wealth management operations moving forward. Now, we do think that there's going to be some impact on savings and therefore wealth accumulation, but broadly speaking, we do think that the wealth management operations are going to hold in a lot better than some of the other facets of financial services. And given that geographic dispersion as well as concentration in wealth management, both of those names actually start to hold out very well, particularly given the fact that we've seen a downdraft in the life cos over the, I guess, since Trump's inauguration.
And finally, a smaller player, Laurentian Bank. You think it's too early to go back into that name?
Yes, I mean, when we take a look at the price performance of Laurentian, it's actually been holding in reasonably well within context. But as we take a step back and look past, hopefully, what's the tariff issues, Laurentian is still working towards fixing its operations, right-sizing its platform, and we still think that there's a lot of heavy lifting and work to be done before we can really say that, yes, the coast is clear of Laurentian and it can be able to carry on growth. So right now, we're still very cautious on the name, but very much looking forward to the day when we actually can say, yes, the platform is fixed and we're going to see growth moving forward.
Right. Okay. I think we better jump. And so you have buys on Sun Life and Manulife. Just very quickly, if I could, you have a hold on Great West. Why is that? Why are you less keen on that one, John?
Just because of the relative performance that Great West has had. It's actually been one of the strongest performers out of our group. And as we brought down estimates for everybody, Great West included, even at the same degree, its valuation multiples and its absolute valuation levels is still, we don't see the upside on Great West relative to some of the other peers.
John, always great hearing from you. Thank you very much indeed.